In January 2000, a company called Pets.com went public. It had $619,000 in revenue and a $300 million valuation. 9 months later, it was bankrupt, and it took the entire stock market down with it. Right now, 4 tech companies are spending $725 billion on artificial intelligence in a single year, and 95% of the companies actually using that AI cannot point to a single dollar of measurable return. So the question everyone is asking is simple: are we watching the same movie again? And more importantly, what happens to your money if the ending is the same? In Chapter 1. What is an AI bubble, and how did we get here? A financial bubble is not complicated. It is what happens when the price of something runs so far ahead of its actual value that the gap between the two becomes impossible to ignore, and then impossible to sustain. The AI bubble started building the way every technology bubble starts building, with something genuinely impressive. ChatGPT launched in November 2022. It reached 100 million users in 2 months, faster than any technology product in human history. And the money followed the excitement the way it always does. Nvidia's market cap went from $365 billion at the end of 2022 to over $5 trillion by 2026. That is a gain of over 1,200% in roughly 3 years. For context, Apple took 42 years to reach $5 trillion. Meanwhile, Microsoft, Amazon, Google, and Meta collectively decided that AI was the most important bet they had ever made. In 2023, they spent $162 billion on AI infrastructure. In 2024, that number jumped to $246 billion. In 2025, it hit $448 billion. And in 2026, the combined projection is $725 billion in a single year. To put that into perspective, that number as a percentage of US GDP exceeds the Apollo space program, the interstate highway system, and the 2027 estimate is already above $1 trillion. So that is the supply side of this story. The demand side is where it gets uncomfortable. Chapter 2. The gap that nobody wants to talk about. Here is the number that should be on every financial news ticker, but somehow never is. MIT's Nanda Research Group published a study in August 2025. They found that 95% of organizations using generative AI reported zero measurable return on their investment. Companies are spending hundreds of billions on AI, and 95% of them cannot point to a single dollar of profit it generated. Now add this. Between 2023 and 2026, the 4 largest tech companies will have deployed approximately $1.6 trillion in AI infrastructure. To justify that spending at even a 10% return threshold, the industry needs to generate $160 billion in new annual profit from AI alone. The Shiller CAPE ratio, which measures how expensive the stock market is relative to long-term earnings, exceeded 40 in late 2025. That level has been reached exactly once before in history, right before the dot-com crash. Chapter 3. Is it going to burst or keep going up? Here is where the honest answer becomes uncomfortable, because this is not a simple yes or no. Nvidia generated $215 billion in revenue in fiscal 2026, with net margins of 53%. At the dot-com peak, Cisco traded at 472 times earnings. Nvidia today trades at roughly 24 times forward earnings. So the honest answer is this: parts of the AI market are in a bubble. Parts of it are not. Nvidia selling physical chips to real companies at real margins is a fundamentally different story than a startup valued at $5 billion because it put the word AI in its pitch deck. The question is not whether AI is going to change the world. It already is. The question is whether investors are paying prices that assume a version of the future that requires everything to go perfectly. And markets that price in perfection have a long history of being very wrong. Chapter 4. What happens if it bursts? Let us say the pessimists are right. So if the AI bubble bursts, the technology does not disappear. The data centers keep running. The chips keep working. The models keep improving. What disappears is the inflated valuations of the companies that built it all. And what that means for you specifically depends on where your money is sitting. If you own broad index funds like the S&P 500, the top 10 stocks currently represent 35% of the entire index. Most of those are AI plays. A 50% correction in AI stocks, which is historically modest compared to what happened after the dot-com crash, would drag the entire index down significantly. The S&P 500 returned -9% from 2000 to 2010. A full decade of zero returns for the most diversified investment most people own. That is what a bubble bursting can do to a portfolio, even when you did everything conventional financial advice told you. The real takeaway. Here's what the data actually says. The AI bubble question is not binary. Some of it is a bubble, some of it is not. The technology is real. The use cases are real. The productivity gains are real. But $1.6 trillion of capital deployed between 2023 and 2026, with 95% of the companies reporting zero measurable return, is also real. And that gap has a name. Every generation of investors has seen a version of it. The technology works. The investment runs ahead of the returns. Reality catches up. And the people who understood the difference between the value of the technology and the price being charged for it came out the other side just fine. The ones who confused the two spent the next decade waiting to get back to zero.